Hi everybody, how we doing today? Today we're going to be covering chapter 14 from our textbook. The chapter is called The Basics of Capital Budgeting. But we're not doing the entire chapter. We're going to be focusing on pages, I think it is, hang on one second here, pages 529 to 545. So pages 529 to 545. Those are the pages out of chapter 14 that you will be responsible for. So in the meantime, what I'd like to do is bring up my Excel spreadsheet. And hopefully you can all see it. I hope everybody is healthy, doing well. We have one more week of these live presentations, so obviously this week, and then we'll have one next week as well. Next week's topic will be on chapter 17, and that's financial condition analysis. Personally, I think that's the easiest material of the entire course. So, but that's just how I feel about it. There's other things that, you might think is easy and I might think it's hard and vice versa, but I think the last chapter is the easiest. So we'll see how that turns out. Okay? So, like I said, hopefully you can see my screen. And chapter 14 talks about capital budgeting. I got a few little blurbs up here that I'd like to share with you. I've actually already posted the notes that you see to the right of the screen. I've already posted that to Blackboard, so you've got a copy of that, so you don't have to sit there and write every single word that I have there. So what are we trying to do here? So you take a look at cash flow analysis. Right? In other words, we've done a cash flow statement before, and now we're going to really dive even deeper to what the cash flow is from period to period. So we took kind of like a look at one period back in a previous chapter. Now we're going to look at cash flows in subsequent periods and try to determine, things like payback, net present value, internal rate of return, and modified internal rate of return. So that's what I want you to be able to do in this chapter. Nothing else that's in the chapter, you're not responsible for anything else, just the stuff that we're going to cover here today. Okay? So over to the right of the screen, I have a little definition for each item. First thing is payback, probably the easiest thing in this chapter, and that is, how long does it take you to get your money back? Right, so in years. So the number of years it takes for business to recover its investment in a project without considering the time value of money. There is another way to do it, which is called discounted payback. You can find that on page 538 of your textbook, but that one you are not responsible for. Okay? Alrighty. Next thing, NPV. And that stands for net present value, basically is a return on investment metric. All of these are return on investment metrics, and they measure, basically net NPV measures information with time value of money into account. In other words, that present value, future value stuff that we did in the previous unit, well, it takes advantage of that information. All right, so it utilizes present value in your results. Okay. The next one that you see there is IRR, internal rate of return. And as you can see there, this one also uses present value information. However, the difference is that, we're looking at a percentage as opposed to a dollar value. Okay. And then you have the modified internal rate of return, which is MIRR, and that one is a better version of IRR, the internal rate of return. Right? The differences with the internal rate of return, we have the use of present value. So you're taking your numbers and you're bringing them to the present, where modified internal rate of return brings your figures, your cash flow amounts to the future, to like a terminal time, all right? Your terminal amount, okay? Terminal meaning the end, all right? So underneath MIR, I have, in general, the modified internal rate of return is less than the IRR, the internal rate of return, when the IRR is greater than the cost of capital, but is greater than the IRR when the IRR is less than the. I'm sounding like anyways. That's just a little summary of the difference between IRR and the modified internal rate of return. Basically, with the internal rate of return overstates the profitability of profitable projects and understates the profitability of unprofitable projects. Okay, and then there was one thing I wanted to point out that I didn't talk about earlier, and that was if you go up to NPV, and it says here a positive net present value means that the project will be profitable. So the higher the NPV, the better. If you get a negative NPV, then the project will not be profitable. All right, so if I ask you, let's say on a test, to compare two projects and which one is the best, and you happen to be analyzing the NPVs of both projects, you can tell me NPV of project A is, project A is better than project B because project A has a positive NPV or a higher NPV, stuff like that. So you can use this stuff to help you determine what is the best project, to invest in. So if you're trying to decide between the two, this might be something that could help you figure that out. Now, we did something similar to that when we were in the previous chapter looking at present value and future value. If you look at two different projects and you bring them both to the present or you bring them both to the future, you can kind of decide which one is the better decision. But now we're looking at cash flows and taking a lot of other things into account as well. All right. So again, like I said, if you have your book handy, you can have it out or you can go back and look at it later. But the information that I have in this little yellow box at the left is information that starts around page 529, 530 of your textbook. You don't even need to go there. This is a summary of that. Okay. And what we want to do is basically be able to answer these four questions. Calculate the payback, calculate the NPV, calculate the internal rate of return, and calculate the modified internal rate of return. Right? The payback the answer will be in years. The NPV will be in dollars. And the last two will be interest rates. Right? So let's just put that in here. So this would be in years. This would be in dollars. This will be an interest rate. And so will the MIRR. Okay? All right. This is going to be a quick video, by the way. It won't take us as long as the previous one, so don't be surprised when we're done quicker than you may have expected. So what I'd like to do is now do some calculations with you. Just like we saw in the previous chapter, you can use present value tables to figure out your present value amounts. You can use your smartphone and you can use Excel. Today I'm going to focus strictly on Excel because I think it's pretty easy to utilize it. So I'll try to break it down for you as much as possible. Okay, so what we want to do is first thing calculate payback. One way you can do is just use common sense. I mean, we spent $2.5 million initially. How long will it take to get us that $2.5 million back? All right, so in the first year we bring 510,000 exactly. So it's going to take us more than a year to get our money back. So how fast is it going to get for us to get our money back? So if you look at it, 5 and 5 and 5, that's like 1,500, a little over 1,600. Then you're looking at this one, little, still not quite there. So somewhere between year 4 and year 5, we will recoup that 2,500. So what you might want to do when calculating payback, I mean, you could say, if you wanted to be just generic, I think we're going to get our money back somewhere between year 4 and year 5, somewhere in year 5 maybe would be a more accurate result, because by the end of year 4 we still don't have the 2,000,005. So somewhere in that 5th year. So let me show how you can actually calculate this. So let's call this payback. We'll do the calculation right here. And initially we are out 2,000,005. But then after the first year, we have earned $510,000. So let's add that 510 to the 2,000,005, and you can see that we are now etching closer to zero. So in essence, we're trying to figure out break even, right? But in a time point of view. I even have that over here to the right. Basically, it's break-even analysis from a time perspective. So we want to get to zero, how we want to make back that 2,000,005. Well, if I take this negative 1,990,000 and I add back another 535.5, now we're at 1,454,000. So we're basically trying to get to zero. The super negative number we're trying to bring up to zero. And then let's add another 562. That brings us to 892,225. Still not at zero yet. Let's take that number and add back the amount that we got in year 4. And notice I'm still not to zero. So I've gone through 4 years and I still haven't made my money back. But look what happens in that 5th year. I made 1,369,000. That's going to put us into the positive. Right? So let's just finish off what we were doing here. Let me add this 1,369,000 to show you that we now have a positive result. Okay. In order to get the exact number, so obviously it took more than 4 years. So sometime in the 5th year, we basically broke even, or we calculated our payback. But if I wanted you to calculate, which I will on the test, want you to calculate the exact number, right? What I need you to do is this. So to calculate your payback, you are going to take your the last negative number that you see there. So that 301. Do this 301 836. And you're going to divide it. You don't have to enter it as a negative, though. Just enter it as a regular part. All right, you know what? Let me just get rid of the parentheses. So you're going to take that 301, 836, right? And you're going to divide it by your last cash flow amount where you finally go over. All right, so that 1,369,908, right? So basically that's what you're going to do. So if you do that, let me actually do that calculation and divide it by this. I get 0.222, and I'm going to ignore the negative here. I get 0.22. Right? So remember that we know that the answer is going to be somewhere in the 5th year. So then what you're going to do is you're going to add the 4 years, 4 years and 0.22 of a 5th year. So the actual result is it's going to take you 4.22 years to get your money back. You could also say this, what's 0.22 of a year? Well, there's 12 months in a year, right? So if we take 12 months and we multiply that by 0.22, 12 divided by multiplied by 0.22, that gives you about a little bit over 2 months, 2.5 months. So you could also say the answer is 5 years and 2 months, 2.5 months. Approximately, something to that effect. All right. So you could, let's say this was a test question. I said, so what's the payback in years? You could say 4.22 years. So technically that's the right answer because that's in years. Or you could say 5 years and 2.5 months. I would accept either answer. All right. So that is how you calculate payback. Okay, I hope that wasn't too confusing. So if it's too confusing, then just use common sense. You know, how long will it take you to get your money back? You know, so after year 1, I still don't have 2. I don't have it after year 3. I don't have it year 4. So sometime in year 5, I'm going to get my money back. I'm just calculating the exact answer. Okay, I can even figure it out to the day if I wanted to. Could have said 365. You know, 365 multiplied by 0.22, right? Assuming that we had that. So 365 that's about 80 days. All right, and there's approximately 30 days in a month. So 30 and 30 is 60. Another 20 days. You can see where I came up with my estimate about, 2.5 months. Okay, so a lot of different ways you can do it. All right, let me just clean this up. So all that is related to payback. So as we said before, when you go to calculate payback, your answer is going to be in years. We have that answer. Second thing, NPV, net present value. All right, so present value, big part of this process. In fact, present value wasn't involved at all in payback. That's the weakness of payback. So if payback had one weakness, it was that we didn't take the time value of money into account. That's why on page 538, they show you the industry practice of a discounted payback. So when they start talking about discounted, they're talking about bringing present value into account. So it's a pretty clear illustration on page 538 to the left. You're not expected to use that on the test, but I think you should be able to go there and take a look at it, all right, and see the difference between the two. All right, they're saying, just FYI, in case you don't have the book in front of you, that if you take time value of money into account, okay, remember, time value money basically means your money grows. your interest earns interest. So it's a compounding interest kind of thing. So according to this, it would take approximately 4.9 years to get your money back, to recoup that. All right. So instead of 4.22 years, it would take 4.9 years. Okay. All right. So let's go ahead and do the net present value. Okay. And to calculate net present value, we need to kind of create a little Excel formula. And I don't know if you remember this, but remember last time, our last session, when we wanted to calculate future value, we entered equals FV, and then like information popped up as to what we could enter. If we wanted to calculate present value, same thing. Well, same thing with NPV, same thing with IRR, and the same thing with MIRR, which is really cool. So let's go ahead and do that. So let's calculate the NPV. So I'm just going to write NPV over here. And actually, I'm going to skip a line. And to calculate NPV, what you're basically going to be doing is you're going to be following this little formula. So I'm going to hit equals and then NPV. All right, so all of a sudden there's already some instructions. I'm going to hit the open parentheses and look what it has under there. The first thing that it wants is the rate. Okay, and my rate is right here. So if you end up doing this on Excel, which I really, really recommend that you do, then make whatever information I give you in the test question, create a data box like I have here. All right. This way, instead of you typing the incorrect value, and remember how we had entered in as a decimal. So if you just click on the value, it'll automatically put it in properly. All right. So I didn't recommend that last time, but I think it's really the best way to do it. All right. So we're going to put in the interest rate, which is in cell A2. And I tried to use the exact same information that's in your chapter so that you can follow along even with looking at the book. Same Excel spots, so it's exactly the same. All right. So then the next thing we want to do is we want to take all of the values, right? So from basically A4, all the cash flow values. So I'm going to put a little comma, all right, after the A2. Then I'm going to skip down to all the cash flows. So I'm taking all the cash flows. Look what the formula did. It saw that I held down the shift key and moved my arrow key down. You could do it separately, each one individually if you want, but A4 to A8, okay? And then I'm going to close the parentheses, right? And then I'm going to hit the plus sign, and I'm going to click on my initial outflow. All right, so look what I've done. I put the interest rate in, then comma, and then I put in all of the cash flow amounts, close the parentheses, and then when it's done, I want to add back that $2,000,005. And if you do it properly, you get $82,493, $492.60 to be exact, right? So is this good or bad? Well, it's good because it's positive. So automatically, because I got a positive result, that means that this project is going to be profitable. Okay. If it had been negative, then I know this project would not have been profitable. Now, if I'm comparing this data to another one, right, and this NPV is higher than the other one, then this one's better. Okay, so because we got a positive value, the project will be profitable. Right? And just to show you what I entered in the Excel formula, I had NPV, so I hit equals, typed in NPV, and then I clicked on cell A2, comma, and then I clicked on A4 to A8, close the parentheses, and then added what was in A3. So that's the actual formula that I entered. If you don't believe me, let me click on the 82,492 and you'll see it right there. A2, comma, A4, colon, A8, close the parentheses, plus A3. Don't add an extra parenthesis. Don't put another one at the end of A3. Excel's going to go, you made a mistake, you screwed something up. So this is how it's got to show up. All right, so there's your NPV answer. And we're concluding that this is a profitable project. And this is in dollars, don't forget. Okay, so now let's do the internal rate of return. I just got to find a good color. Okay, let's go deep blue. So to do the IRR, what I'm going to do here is hit equals and then type in IRR and open the parentheses. And now it's asking me for values. And with this one, I basically want to take all my numbers except for the percentage. Okay, so I'm going to click on that 2500, so A3, and I'm going to go from A3 to A8 and then close the parenthesis. And I get 11%. Let's see if that's exactly 11. Let me. All right, so about 11.1%. So how did I get that? I hit equals, IRR, I opened the parentheses, and then I basically went A3 all the way to A8. And just in case you don't believe me, there it is again up there, equals IR A3 colon A8. And I got 11.1%. Okay. So as I have over here, the IR tends to overstate the profitability of projects, where MIR kind of like pulls back on the reins a little bit, say, hey, take it easy. It may not be as good as you think. It'll still be good, but not as high as you may have thought, right? Or vice versa, depending on what you may have gotten. So let's go ahead and do the last one. And I guess I'll use this color. So MIR. So in this one, hit the equal sign, start typing MIRR, and notice that that is a function that Excel can handle. Open the parentheses for the instructions, and notice it says it wants the values. Okay, so A3 to A8. So let's do that. A3 to A8. Comma. I'm going to click on the 10%, A2, and I can't explain this, but then we got to click on that again. So we're basically clicking the interest rate twice. And if you do that, it comes up 11% again, but let's be more specific, and we'll see that in reality, it's about 10.7%. So again, how did I get that? Equals MIRR is what I typed. I open the parentheses, and then I'm going to have A3 all the way down to A8, comma, A2, comma, A2. Close the parentheses. So let's just see if that's what I did. Equals MIRR, parenthesis open, A3 to A8, comma, A2, comma, A2, close the parentheses. And that's how you get the modified internal rate of return. Wish I had these tools when I was in school. They didn't have Excel back then. Wish they did. But that's how you do it. All right, so just one last thing before we get out of here. What if I were to copy this data and let's say I were to change the rate to, actually, you know what? Hold on. Let's copy from here to here. And let's say I change the rate to 11%. So if I were to change it to 11%, what would you expect the payback to be? If you said no change, you're right, because payback is all based on how many years does it take you to get your money back. So payback would be exactly the same. So I want to change this from 10% to 11%. Our payback answer would be the same. NPV, all right, so if we calculated net present value, now the cost, the cost of borrowing basically has gone from 10% to 11%. So are you expecting your NPV to be higher or lower? Because now we're changing this to 11%. Okay, so let's change it to 11%. And notice that we get 7,095. So if you were comparing these two projects, one at 10%, one at 11%, in other words, let's borrow money at 10% versus borrowing money at 11%. If you're going to be paying higher interest, the net present value of the project is going to be a lot lower. Look at that. That 1% went from NPV of 82 grand to 7 grand. Notice the IRR stayed the same and the MIRR changed a little bit. Let's see if we can make that. There we go. Make this a little bit more. That stayed the same. Okay. Let's do one more calculation. And what if we were to change it to 12%? So 11% brought the NPV from 82 grand down to 7 grand. Let's see what 12% does. And look at that, negative 65,000. So if our cost to borrow went to 12%, then this project would now become unprofitable. That 1%, notice it gave us a negative NPV. So if, in the test question that I give you, if you end up with a negative NPV, that basically means the project is not profitable. Okay, that's it. So, you need to be able to calculate, if we go back to the original information, you need to be able to calculate payback, NPV, IRR, and MIRR. RRRR. All right, that's it. I hope you guys are doing okay. Next week, I think we get into the easiest subject of the semester. Basically, we're doing financial ratios. We're looking at financial statements and doing, gross profit analysis. We'll probably do some vertical and horizontal analysis. We'll look at different types of ratios, like more analysis, trying to figure out if a business is in good standing or not. Okay? All right, I'll upload these notes into Blackboard so you've got a copy of them. And till next Monday, we'll see ya. All right, next Monday is our last recorded session. And then after next Monday, I will upload the final exam. All right, take it easy. Hope you guys are okay. This time, what I want you to do, after you get done watching this video, instead of just texting me, I did it, I want you to text me and include a picture of yourself. I need to see you guys. I forgot what you look like. All right, so you now have 2 jobs. Not only to text me you watch this, but in that same text, send me a selfie. So you get to see me, but I don't get to see you. That's not fair. All right. So let me know how you're doing, and we'll see you next week. All right. Bye-bye.